So let's start. So in our last session, we did look at the net present value. So we are on investment appraisal techniques. So we did look at the net present value. We also did look at the accounting rate of return. We also did look at the payback period. So today we are moving on from the last thing that we covered yesterday. So in today's session, we are going to be talking about the internal rate of return. So IRR method of investment appraisal. So let's have this up here. So internal rate of return. That's what we want to look at. So we'd already written the subheading last time. So what is the internal rate of return? So that is the first thing that you need to know. So internal rate of return. So the internal rate of return tells us the maximum. It tells us the maximum return that is expected. The maximum return that is expected from investing in a certain project. So if we are to invest in project A, how much is the maximum return that we're expecting? That's the internal rate of return. So this rate of return gives us a net present value of 0. So the IRR gives a net present value of 0. So if you are to calculate your, if you are to discount your cash flows at the internal rate of return, you get a net present value of 0. So at IRR, the net present value is 0. So what is the decision rule? Before we look at the question, how we apply the IRR, what is the decision rule? So for internal rate of return, this is the maximum that we're expecting to get from the investment. So remember last time we talked about the cost of capital. So what did we say the cost of capital is? The cost of capital is the minimum return that investors are expecting from the project. So the cost of capital, this is the minimum return. We're saying, okay, if we've invested in the company, if we've invested in the project, sorry, if it's 10%, we cannot accept any investment which is a return less than 10%. Then we come to IRR and we say this is the maximum return we're expecting. So on the decision rule, if the IRR, that is the internal rate of return, if the internal rate of return, just watch my laptop on the charger. So if the internal rate of return is greater than the cost of capital, we accept the project. If the internal rate of return is greater than the cost of capital, we accept the project. Because Shuguti Isusu, the internal rate of return, that's the maximum we're expecting to get from the project. Then the cost of capital is the minimum we expect. So if the maximum we are expecting to get is higher than the minimum, then we accept the project. So If we are saying if Ziganzizo, our cost of capital is, let's say, 10%. This is the minimum. We accept any project above with a rate which is a return above 10%. Then our IRR over TTEO, we are expecting to get 13% as the return. Since the expected return is greater than the cost of capital, is greater than the minimum we can accept, then we should take the project. But if the IRR is less than the cost of capital, is less than the minimum we can accept. So 10% is the minimum we can accept. So this is our minimum acceptance. So if it's above the 10%, we accept. So if the IRR is equal to the cost of capital, then the project breaks even. So the project breaks even. It means we are indifferent. We can go for the project, but it doesn't give us any return. So if it's equal to the cost of capital, we don't make a loss. We are also less likely to make a profit. So that is if it's equal to the cost of capital. We can, however, go ahead with the project if it has non-financial benefits, such as maybe if we are still new in the industry and we just want to get recognized in the market. So we can still go for the project as long as we are not going to be making losses. So we just want to penetrate the market. We can still accept the project. But if we are aiming for a profit, then it means we need a project which is above, with an IRR above the cost of capital. Then if it's below the cost of capital, then we can't accept that project. So that decision rule is very important because remember, we're going to be evaluating different decisions. Then let's now move on and look at the formula, internal rate of return formula. So our IRR formula says that the internal rate of return is equals to A plus D, open bracket, I'll just say P over P minus N. So what are these variables representing? So A is the rate giving a positive NPV. Rate giving a positive NPV. So IRR uses two discounting rates. So there's one rate that you're going to use which will give a positive NPV, and the other one would give a negative NPV. So A is the rate that gives the positive NPV. Then D is the difference in the rates. We have used two rates, one giving us a positive NPV and the other one giving us a negative NPV. So D is the difference in rates. Difference in the rates. So we're saying the rate giving us a positive minus the rate giving us a negative. We're going to have an example to demonstrate that. Then P is the positive NPV. Positive NPV. Positive net present value. Then the N is the negative NPV. So N is our negative NPV. So from there, we then move on let's now have our example that we did, and use the NPV, sorry, and use the IRR too. So let's go back to that question that we did. So KG is considering investing in one of the following projects, Project A and Project B. So we had been told both projects are expected to have a new residual value after 5 years. The company's cost of capital is 10%. Advise the company on which investment they should choose under each investment appraisal technique. So we have used the payback period, the ARR, and NPV. Now we're moving to the IRR. So for IRR, we need two discounting rates or two net present values. So you're going to use 10% that they've given us and another discounting rate. So for IRR, we are going to use the given discount rate, the given cost of capital, and another cost of capital to calculate the net present value. So we are given just one cost of capital, which is 10%. So at 10%, for project Edioctanga, we've already calculated our net present value using 10%. Remember what we did last lesson? So we already calculated our net present value using 10%. So we said, the discounting factors at 10%. So if we calculate the discounting factors at 10%, it gave us a positive net present value of 3,245. So it gave us a positive net present value of 3,245 if we use 10%. So there is no need for us to repeat that. So we're just going to say at 10% cost of capital, the net present value is 3,245. So at 10% cost of capital, the net present value is 3,245. So now we want to look at, we want a higher rate. So what do we do to get, because for formula we need a positive NPV, and now we already have the positive NPV. So positive net present value tutorinayo. So negative NPV tunayowana say, we're going to choose any rate, but kuti izobuda iri negative, it should be a higher rate. So the higher the rate, then negative NPV negative reduces. So if we increase the rate, the NPV reduces. If we increase the rate, the NPV reduces. If we increase the rate, the NPV reduces. So if 10% is giving us a positive, let's find a higher rate than 10%. Let's find it a bit far from 10%. Let's use at least 20% and see. So let's use 20% to not my NPV. So let's calculate the same calculation at the net present value using 10% rate. Now we're doing this using 20%. So the cash flows are not going to change. So let's just have those same cash flows. But now we are using 20%. So you can say using 20%, or let's just put 20% here. So we are now calculating net present value again but using 20% as our discounting rate. So toda kutsvaga the discounting factors. So for the discounting factors at 20%, remember the formula for calculating the discounting factors if you're not given them. We said it's 1 plus the rate to the power minus n. So we're going to use that one. So we're going to say 1 plus rate, which is 1 plus 20%, 0.2. So it becomes 1,2. So you're saying 1 plus rate. If you say 1 plus 20%, 20% in decimal is 0.2. So 1 plus 0.2 just becomes 1,2 to the power negative. For the first year, it will be to the power 0. So it's 1. For the second year, it's 1,2 to the power minus 1. So let's just round that to 3 decimal places. So 1,2 to the power, this is minus 2, second year. Just round to 3 decimal places. And finally, so having these discounting factors, we then multiply the discounting factors with the cash flows to get the present values. So for the first one, Nongodzogari minus 50,000. For the second one, it's 25,000 times 0.8. Okay, let's just sum them up then. So we copy the same function. So we've been multiplying the cash flows times, we've been multiplying the cash flows times the discounting factor. So what is the net present value? The net present value. So our net present value is negative. If ikaramba ichidai positive, it means rate yako apa, choose a higher rate. So in this case, we now have our negative NPV. So if the cost of capital, is 20%, the net present value is negative 5668. So now we have our variables. So if we come here, the rate giving us a positive NPV is 10%. The difference in the rates, if you say the difference in the rates, if you say 20 minus 10, because we've used 20% and 10%, the difference in the rates again is 10%. Then positive NPV. So positive NPV, we got positive NPV as 3245. Our negative NPV is 5668. So now we have our variables. So It's now a matter of us substituting these variables into the formula. So let's copy this formula. So we are going to say A, which is the rate giving us a positive NPV, which is 10%. So 10%, or you can just remove percent and work with the 10. Then the final answer, we are going to restore the percent back. So 10, we have removed the percent. So the rate giving us a positive NPV is 10. Even if you use the percent, the answer is supposed to be the same. Then the difference in the rates, 10 and 20, the difference is 10. Then the positive NPV was 32, it was 32.45 over the positive minus the negative. The positive NPV, 32.45, pay attention here, is the positive minus negative. But since the negative NPV already has a negative, so if in maths, if you say negative, if you say minus, because on the formula we have a negative, and the NPV itself is a negative. So minus and the minus gives us a plus. So it becomes 56.68 because there is a negative for the negative NPV and the negative on the formula, giving us a positive. So first simplify what's in the bracket. That's 10 plus 10. Please don't add bracket before simplifying what's in the bracket. So we add 32.45 plus 32.45 plus 5,668. That would be 89.13. Then 32.45 over 89.13. So next step is 10 plus 10. Bracket, it means you're multiplying. So if you say 32.45 divided by 89.13. That's 0.364. So if we proceed with this, becomes 10 plus, if we say 10 times 0.634, that's 10 times 0.634. Zero 0.364. That's 3.64. So the final answer then becomes 13.64. So 13.64%, that's our internal rate of return. So it means if you calculate your IRR using 13 point, if you calculate your net present value using 13.64, you get a net present value of 0. So at IRR, your net present value is 0. So since the internal rate of return is greater than the cost of capital, we accept or we proceed with the project. So if the IRR is greater than the cost of capital, the decision is let's proceed with the project. It's profitable. It's giving us a return higher than the minimum expected return. So that's the internal rate of return. So what's the key thing to take note of? The internal rate of return, we need two net present values, a positive and a negative one. So the positive, one of the discounting factors, we are going to use the cost of capital. If we have used the cost of capital given, if the net present value was negative, it means to get a positive one, we would need a lower rate. But if you want a negative NPV, it means you have to go for a higher rate. So put it a negative, we need to go for a higher rate, but put it a positive, we need a lower rate. So let's evaluate now. Let's have the advantages of internal rate of return. Advantages of using internal rate of return. So if you're using the internal rate of return, it considers the time value of money. So the internal rate of return, since it discounts the cash flows, like the net present value, it also takes into account the time value of money, which we discussed last time. So $1 today is not $1 tomorrow. So it takes into account the time value of money. This one. Then besides that, it uses cash flows, not profits. We said what's the benefit of this? Cash flows are less subjective than profits because profits are easily manipulated. So it means the same advantages of net present value, they can apply for internal rate of return. Most of them, they do apply because they have most things in common. So it is, unlike the net present value now, this one, it is a relative measure, which makes it easy to compare. So we said relative measures, percentage. It's easier to compare if you are dealing with percent. So percentage, we can easily compare projects with different sizes. Then the disadvantages. So for internal rate of return, what disadvantages can we face? So if we are dealing with it may be difficult. To determine the cost of capital to use. So when you're calculating like what we did, we had to pick 20, but it might pose some challenges to figure out which cost of capital should I use to get a positive and a negative NPV. It may not be reliable when comparing mutually exclusive projects. If projects are mutually exclusive, we are saying they have no link between them. So if we are comparing two projects that are mutually exclusive, it means they have no link. Which this project does not affect the other. So if the projects are mutually exclusive, IRR might not give us a reliable measure of which one is the best. So, like we're just looking at 2 for each. Then let's move on and look at investment appraisal with foregone cost of capital. Investment appraisal with a foregone decision. So investment appraisal with a foregone decision. So it means there was something that you were doing that was a consuming cost to the organization. Like we can have a case equity, the organization was renting. Maybe we were renting a bus to transport our employees, or we were renting, it could be premises, but now we are considering buying our own premises. So when we choose the decision to buy our own property and stop renting, it means we are going to be saving the cost of rentals. So when we choose to stop a certain activity that's consuming costs and go for another activity, the costs that we have saved, they are regarded as cash inflows. So we can say if there is a decision, or we can say if the organization was incurring costs and they are deciding on which project to go for, which result in saving costs. Saving costs that are being incurred. The costs saved become cash inflows. So we were saving the cost, but now we have chosen the decision. We were incurring costs, and now we've chosen the decision to go for an alternative, which is going to result in us making those payments. The cost that we have saved is an inflow. So let's have an example to demonstrate that. So we can say KD Limited has been hiring a bus to use, has been hiring a bus to use for its employees. The annual cost for hiring the bus are expected so you can say currently $20,000. These are expected to rise by 10% each year. These are expected to rise by 10% each year. These are expected to rise by 10% each year. These are expected to rise by 10% each year. If the organization acquires their own bus, the cost of the bus is expected to be 50,000. Is expected to be 50,000. Half is payable now, and the balance after a year. The balance after a year. The operational costs of the bus per year are expected to be $2,000. The operational costs for the bus are expected to be $2,000. So calculate the expected cash flows for 5 years and the payback period. Calculate the expected cash flows for 5 years and the payback period. So we had we were hiring the bus. And for us to hire the bus, it means we are going to be incurring a cost annually. And this cost is not fixed. We are told now, as we are making the decision, the cost is 20,000. And it's rising by 10% each year. Then if we buy a bus, we are going to pay 50,000 and we pay half now. As long as it's now, we are in year 0. If we're talking about now, that's year 0. If 50,000 is being paid now, half is paid now, it means it's being paid in year 0, and the balance is being paid after a year. So let's have, we want to calculate our cash flow. So we are going to put our years horizontally. So let's have the year 0, year 1, year 2, year 3, year 4, year 5. So we need our net cash flows. Let's calculate the net cash flows. So let me calculate the expected. Let's put net here, net cash flows. Expected net cash flows. So please pay attention to this part. So we are going to say cash inflows minus cash outflows. to get your net cash flows, so we need the cash inflows. So we need our cash inflows. So the foregone cost becomes the opportunity cost, it becomes the cash inflow, the foregone cost. So foregone cost is going to become a cash inflow, but it will start becoming a cash inflow in year one because we are going to, if we are to invest now in the bus, it means from the next year, we are no longer going to be hiring the bus. So from year one, the costs were said to be, currently they are 20 and we're expecting they are going to be increasing by 10%. So we're going to say, so it means next year the costs will be 20,000 times, you add 10%. Then in year two, 20,000, you add 10%. So the fastest way of adding 10% is just multiplying by 1,1. So, sorry, it's supposed to be 22,000. So the costs are increasing by 10%. So you take this cost, you multiply it by 1,1. That's increasing by 10%. Take this cost, you multiply it by 1,1. Increase it by 10%. So the costs are increasing by 10%. Let's just round to the nearest whole number there. So the costs are increasing by 10%. But in accounts, I think one decimal place is okay still because money is rounded to two decimal places if the question is silent. So these are the cash inflows. Then cash outflows. These are the payments that we are going to be making. So for our cash outflows, the payments that we are going to be making, we have the initial outlay. So we're going to pay for the 50,000 to buy the bus. So we are paying half now, which is 25,000, and the other half after a year, which is in year one. So you pay half now and the other half after a year. Then besides the initial capital, we're going to be paying for the OP costs, operational costs. OP costs. So we're going to be paying for the operational costs. But operational costs, they will start to be incurred when we are now operating the bus. That's in year one. Because year zero, we are still making the decision. So in year one, when the bus is now bought, that's when we start incurring operational costs. So they were said to be 2,000. So there were 2,000. These are costs, so it's a negative 2,000 annually. So our net cash flows will be as follows. So year zero, it's negative 25,000. Year one, so these are our net cash flows. So these are our net cash flows. So it's just the same with saying year zero, our cash flow, there's a cash outflow of this. Year one, there's an outflow of that. Year two, it means there's an inflow from year 2, year 3. So from year 3, there is an inflow again. Year 4. So for year 4, there is an inflow. That year 5, there is an inflow again. So this is the table we're used to, but in this case, it means we had to recreate the cash flows for ourselves. So these are our cash flows. They were not given. So if you're now calculating the payback, we now have the cash flows. When you're calculating the payback, we are going to say, so for the payback in year 0, we have made a cash outflow of 25,000. Then year 1, what happened year 1? Instead of receiving money, there was a cash outflow again of 5,000. So we haven't recovered anything in year 1. It means actually the amount that we need to recover is increased. So by the end of year 1, we needed to recover 30,000. Then year 2, at least positively, we received something. Year 2, we recovered 22,000. So in year 2, we recovered 22,000, meaning we were now left with how much to recover? 7,800. Then year 3, we recovered 24,000. So remember what I said when we were doing the payback, that in the year where our inflows are greater than the amount we are left to recover, we are going to say the amount which we are left to recover, which is 7,800, over the inflow year 3, 24,620 times 12. That's to put in months. So if you say times 12, if you say times 12, that would put it in months. So the 7,800 over 2420 times 12, that's putting it in months. So that's rounding to the nearest, that's 4 months. So it means we need 2 complete years and 4 months to recover. That's our payback period. So that's the 2 complete years and 4 months. Or optionally, we can put it in years. So in years, we said you don't need to multiply by 12. So it means you're saying 2, comma, then you say, you're just saying 7,800 divided by 24,620 without multiplying by 12. So how much does that give us if we don't multiply by 12? It's 7,800 over 24,620 without multiplying by 12. That's 0.32. So you add that to 2, so it becomes 2.32 years. So if you want to put it in years without months, you don't multiply by 12. So that's our payback period. So if the question had asked for net present value, you then take these cash flows and you multiply them. Let's say if they say the cost of capital is 10%. If they say the cost of capital is 10%, remember we already have the discounting factor for 10%. So if you're calculating the net present value, so if you're given the cost of capital and we're calculating the net present value, So we now start from these cash flows that we have calculated. So net present value, then put your discounting factors. So discounting factors for 10%, we had already calculated this. For 10%, you're scoping those discounting factors for 10%. So our present values, you're going to say, so those are our present values. So copy the same function there. These are present values. So the net present value, then sum up these present values. So we sum up these present values. So this would be our net present value. That would be our net present value. Then lastly, ARR, remember, ARR makes use of profits. So if it's accounting rate of return, it makes use of profits. So you need to figure out, is there anything mentioned to do with depreciation? Because this asset that we are buying, it may be subject to depreciation, because if it's an asset, then it's subject to depreciation. Then we need, yes, 25,000 ava pakuti. The question yati, tauda kusiya kwaya kwatachibhadhira ma20 aya. Tauda kutenga redu bus. So kutenga redu bus toda 50,000. But for 50,000, half is payable now and the balance after a year. So half year 25,000. So also another key thing to take note, from an operational cost, it should exclude the depreciation, current cash flows. So NB, for cash flows, we exclude depreciation. Cash flows, we exclude depreciation. But when calculating profit, we include depreciation. So if it's ARR, you need a similar table, but for ARR, you need profit, not cash flow. So you need profit, not cash flows. And for your capital, you're going to be using 50,000, what you have invested. For capital, you're going to be using the 50,000 you have invested, not the 2,000. It's not part of capital, but it's the 50 is capital. We say 50 divided by 2. Okay, so that's IRR for you and also dealing with a foregone cost of capital. So next we are going to look at an exam type question with investment appraisal. Then from investment appraisal, the next thing we're going to talk about standard costing and variances.